I'm here today with Brendan Wallace. He's the managing partner and co-founder of Fifth Wall Ventures, which is the largest venture capital fund focused exclusively on real estate in the built environment. Brendan, thank you for being with me from Connecticut.
Yeah, thank you so much for having me.
You know, you've made some very big bets in the real estate space. I'm thinking Industrious, Convene, Allbirds, VTS, a lot of these companies that are really well known in the industry. And you have a lot of skin in the game with retail. Acadia, Macerich are some of your investors. You've made some bets on brands that started out in e-commerce and now are moving into the physical retail space, which makes this time particularly interesting and challenging for you. And you had written a piece on Medium about a week ago that I thought was quite interesting, where you asked for a $30 billion retail bailout. So we want to get into some of those specifics because we're talking, and we should be mindful, we're talking maybe 2 weeks before what would have been retail real estate's prom night, right? ICSC. And obviously that's off the table. The future of the real estate industry and retail just looks really, really patchy right now. So let's talk about some of those things. What prompted you to write that essay in which you asked for a retail bailout to the tune of $30 billion?
I think what you're looking at is a potential systemic crisis. I mean, the retail ecosystem is comprised of so many different constituents. You have the landlords, but then you obviously have the retailers of all different sizes, all different types and flavors, from the firms that our fund invests in, the emerging new omnichannel retailers, up to the established big box retailers. Then you have the mortgage lenders, you have insurance companies, you have local jurisdictions who collect property taxes, you have the employment base of all the retailers, you have the underlying vendor ecosystem. And I think what's a little daunting here and hard to really frame is that you're to some extent looking at a systemic crisis, right? Because you have the COVID-19 crisis itself, which has in turn prompted these kind of indefinitely closed retail assets. I mean, literally no people are walking through retail assets. And let's just focus on shopping centers, right? To kind of simplify it. They are not open right now. There are some plans to open them, but that's largely state dependent. So
even the ones that are open, like in Georgia, for example, even the ones that are open, apparently no one's going yet. There's still that fear. There's still that sense that this is not a safe space.
Yeah, and that kind of ties into some of the broader, more almost sociological and psychological shifts that are afoot here. So you have the largest forced adoption of e-commerce since the invention of the internet just happened in the last 45 days versus March of last year. E-commerce transaction volumes are up 74%. So many of those customers used e-commerce for the first time. So it's almost like we accelerated the e-commerce adoption curve by 5 years. Plus, we compounded it with a psychological fear, obviously, and I think justifiably, around being in a public place. And then on top of that, you have just a broad freeze in capital markets for both retailers and retail landlords. You just have to look at the publicly traded equities and the debt values of many of these companies to assess how frozen those markets are. And all of that is taking place in an environment where, I mean, many people have discussed the, quote, death of retail, which I've always thought is an overplayed phrase in the press. But what I think is true about it is that you have retailers that are large rent payers that are both over-levered from a debt perspective and overstored. Mm-hmm. And so retail footprints are too large, right? And so many of these retailers needed to contract anyway. So when you kind of add all these forces together, you face what could be a pretty systemic crisis. And you're talking about an industry that is just gigantic in terms of its size.
In terms of employment as well, right? I think that's the premise of your piece, is how to save 1 in 4 American jobs. But I do want to push back on something that you wrote about. You said, that 52 million jobs are at risk. Now, that the assumption in your piece is that putting some money back into these retail landlords and retailers, into the industry, will save a good chunk of these jobs. Now, some of these jobs aren't going to come back even if these retailers are rescued. They will make do with fewer cashiers. The foot traffic is going to be down, not just for a few months, but foot traffic is going to be down for a long time. So a lot of these jobs that you're talking about saving are already gone.
It's very akin to this phrase and this terminology of flattening the curve, right? That has been how a lot of governments and local jurisdictions have thought about responding to the crisis, which is you have otherwise viable people that would not die, that will die on account of a flood of people going to hospitals, ventilators being in short supply. You have this kind of this massive spike, right, in cases. That is almost perfectly analogous to what could happen in retail. You have a lot of otherwise viable retail. These are retailers that do not die, kind of in your phraseology, right? Like there are some retailers, I think we can all agree, don't need to exist and very well would have died in the normal course of an economy. Mm-hmm. But what's happening right now is the credit markets and the equity markets are so frozen. No one is providing any capital to many retailers. Right. That what's going to happen is you're going to have retailers die what I would call unnatural deaths. Mm-hmm. So otherwise viable retailers could fail. And the expectation was that the CARES Act would provide capital specifically to retail. Yeah. But it was, I would say, noticeably delinquent on the provisions for retail, which is surprising, right?
Yeah, it sort of took out a lot, even landlords in general were quite sort of put out by the fact that there was no accommodation made for that industry, right? Real estate in general has been frozen out of the CARES Act, which obviously includes retailers as well.
And the size of the industry is massive, right? You're talking about a $6.2 trillion industry. As you said, it's 1 in 4 American jobs. Mm-hmm. You're talking about over $1 trillion of real estate debt associated with commercial, $1 trillion of commercial real estate debt associated with retail real estate assets. And you're talking about hundreds of millions of dollars of local, state, and sales tax revenues that are just being cut off.
So, also, I mean, broader in a more loosey-goosey way, it's also the fabric of a city, right? What makes a great city is volume, is activity, is shopping.
It's not just, you're right, it's the fabric of a city, right? The street life, the streetscape of having stores is critically important. And I think when we conceptualize that, we think of it as the environment of a city, right? It's the ambiance of a city, but it's also a functioning supply chain, right? If you were to stop goods and services from reaching consumers close to their homes, that's a national security issue. You can't stop goods and services from getting to consumers. We have to keep that flow going. And so the issue is, yes, as it relates to luxury apparel or home goods, those aren't necessities, but you need a brick and mortar retail ecosystem to be functioning just to provide the goods and services to consumers. I mean, today, most people are surprised by this, but 10% of all US retail is e-commerce. Mm-hmm. So if all we're relying on is e-commerce, we are going to face a national security issue, a public health crisis in and of itself.
Your solution, Brendan, your solution in your paper, in your piece, is essentially talk about it in the way that, the way that PPP happened. You're essentially advocating for a $30 billion, but PPP was a debacle, right? The way the funds were allocated, the graft that happened in that system, a lot of big public companies got money from the government when it's supposed to be for small business loans, right? So I find it a little bit, I'd find it difficult to grapple with that given that we just had this debacle and we're talking about injecting a further 30 billion into another new program, which again could be ripe for abuse.
And one distinction is the granularity of the program, right? Okay. So the granularity of the PPP program is kind of what makes it very challenging. A lot of these local banks struggled with the volume of applications, right? And you're dealing with oftentimes very small businesses. I know there were some exceptions, which is, I think, the graft that you're referring to. Large companies that probably should not have gotten PPP loans did, and that should have been prevented. But the vast majority is going to small businesses. In this case, I think what's unique about retail, and where I'm really focused, is on the large and medium-sized retailers. You're not talking about a large universe of companies, but they're huge employers. It doesn't mean that there shouldn't be a reduction in the supply of retailers and the amount of retail real estate. I think everyone can agree on that. It's how fast we want it to happen and the social consequences and the unemployment consequences we're willing to tolerate to just let the free hand of the market go. And I know that your readers are a lot of real estate owners.
Absolutely. I mean, they own some of the biggest stores in the country, and especially in core markets, they have a lot of skin in the game. They're quite worried right now. Even, we talked with some of the biggest landlords in the course of the past few weeks, and they're not seeing much that is making them, that is reassuring them at the moment.
And one of the issues is it's partially a collective action problem. You don't have a monopoly on ownership in retail real estate. So what you face is this collective action problem of any individual retail landlord is saying, I want to protect the integrity of my lease. I want to protect the cash flows coming off of my lease.
Which you did, Brendan, right? Your one of your solutions, which I thought was quite interesting, I want to talk to you about that, is get the 5 largest retail landlords into a room with the government and hash out some sort of best practices, right? Something for, standardized forbearance agreements, for example. Have you, I know you're backed by the likes of Mace, Rich, Acadia, some of the big players in the retail space. Have you had this conversation with people like that? And
so I can't comment specifically on the comments that we're having. What I can say is why I do think it makes sense. And I think there's 2 stages to it. The first is landlords need to act together to solve their collective action problem, to solve the problems, the overstoring problems and the overextension problems and the overlevering problems of retailers themselves. Mm-hmm. And that needs to be solved systemically. So if you're dealing with a retailer that's in crisis, solving their real estate problems with one landlord don't really solve the issue. You need to work with all landlords together. The second thing is that these rent concessions themselves are a form of equity investment, right? Like if you think about it, if you give a rent concession, it's equivalent to paying equity. It's just negative fixed costs, which is the equivalent of positive cash inflows. Mm-hmm. So it's a form of equity. And one thing, to be biased, like we've always advocated for, is that the relationship between landlord and tenant should change, mm-hmm. such that landlords should think of themselves and conceptualize themselves and build relationships with tenants as an equity investor. So I think this is a unique opportune time to affect that. It's not useful if any landlord does it on their own because it's too small, right? It represents too small a percentage of the total retail footprint of any retailer. But if all the landlords come together and work with the retailers and say, hey, let me understand how you're thinking about the go-forward state of your business. Do you think you have too many stores today? Do you think you're paying too much rent because sales are too low on a handful of your assets? And let's sit down with you and collectively, holistically solve your problems for you by either reducing rent or maybe letting you out of a handful of leases. But in exchange for that, we become your equity partners. Because what happens today without that taking place is that rent concessions are being negotiated in hand-to-hand combat, one-off between landlord and tenant. And when you get a rent concession as a retailer, your landlord doesn't get any equity ownership in the retailer. Yep. So in many ways, they help that retailer survive in the same way that an equity infusion into that company would help it survive, but they don't capture the upside. The relationship between landlord and tenant needs to change. It's no longer sufficient to have a purely transactional relationship because the tenants, whether it's an office or it's industrial or it's in retail, they care about a more full service relationship with their landlord. Mm-hmm. And in the case of retail specifically, because you're dealing with a challenged space, you're dealing with an existentially challenged space, in part because of the adoption of e-commerce that we now know is accelerating very rapidly. But you want retailers to survive. And part of that, I think, means aligning your interests with them.
How realistic do you think it is to get everyone together at the table and sort of restructure things and work out some sort of at least short-term agreement in 90 days?
In a normal state of the world, it would be entirely unrealistic. 90 days to start anything is near impossible. Yep. But the issue is that we don't have that long. There's a lot of reports that you can read about the solvency crises that many retailers are confronting right now. And so if this takes a year to come together, it's too late. So who would have ever thought we could have any response, any country could have this kind of public health response to literally shutting down cities? There was no protocol for that previously. but they figured it out fast. I think what we're facing in retail is equally unprecedented, and it requires swift action, and it requires levels of cooperation that we haven't seen before.
The collective action also assumes that retail landlords would want to get in even deeper with the retail industry, right? Because if we're talking about taking equity or taking a long-term view into the company, we're assuming that retail landlords have an interest, and let's just talk major cities right now, where retail real estate can be repositioned. What you're talking about, if I'm getting it right, is an even longer, deeper, more intimate relationship with retail between landlord and tenant. Do you think they'd even want that?
It's a great question. Do they want that? I think that the right question is, do they need that right now? Right now, the top of the funnel in the retail ecosystem is solvent, revenue generating, cash flow generating, rent paying retailers. Mm-hmm. And right now, the assumption that that is a cohort that is going to continue to exist, or at least a big portion of those retailers are going to continue to exist, is no longer safe.
How did you get to your 30 billion number? Just curious.
It's kind of a swag, to be totally candid. I think any amount that you can put in, it's in the tens of billions of dollars if you want to support the sector. To contextualize that, 25 billion today is paid, or I should say in February, was paid in retail real estate rents in the United States. So to every month, 25 billion was getting paid. Today, I think it's a safe assumption to say that somewhere between 70 and 100% of that is not getting paid.
Your fund at the moment, the $100 million retail focus fund, can you even think of deploying capital right now? Or is it more wait and watch situation?
No, I think we're actively deploying capital. One, I think we want to support our existing portfolio companies. This is a time where you really want to lean on your investors that have the long-term interests of a portfolio, the long-term interests of your startup in mind when you originally added them as an investor. So this is the time when you really show your stripes as an investor and build that kind of partnership dynamic between investor and startup.
These from real estate are with you guys in terms of betting even now?
Mm-hmm. Oh, absolutely. Yeah. I mean, to be clear, I think what this has done is it's accelerated a lot of the technological disruption forces that were already well afoot before this crisis, right? So in many ways, this has underscored the necessity and the imperative to look forward and to see around corners and to adopt new technologies that can enhance your core business. So I don't think this is a repudiation of, oh, we shouldn't adopt technology, right? I think if the conclusion a real estate CEO makes from this crisis is, okay, thank goodness I don't have to adopt real estate technology for my assets, I don't think that CEO is going to have their job for that long.